Hi, good day. Let me just quickly introduce myself. My name is Clive Cabernet and I'm a father of 5 lovely children. Most of you have known me as a tax advisor. I am a CRE registered tax e-filer since 2005 and have been servicing to over thousands of clients every tax season. I am also a licensed investment and insurance broker. I also participate in online trading, particularly on stocks and currencies. In my past career, I was a certified public accountant back in the Philippines, and when I moved here in Canada, I gained a progressive career of 13 years as accounting supervisor. So in total, I have over 20 years of experience in both corporate accounting, personal taxation, and of course, personal finance. So why am I capable of offering the best plans for my clients? Because here in Canada, we have 2 types of advisors, a financial broker and a sales agent. Sales agent, they're most likely affiliated with a single company. So the products and services that they offer is basically limited to what the company can offer. While brokers like us, we are more diverse with our approach. We can actually be contracted with multiple companies offering different plans and different products from different companies. So our clients have more choices. An additional benefit on me as my client is I can incorporate effective tax planning along with your financial planning. Hi, our topic for today is all about life insurance and the different types of life insurance. The first one is the term insurance. That's the very first insurance ever created in the market. As the name itself, term, meaning it's only temporary within the term. But if the client will die after the term, then there's no more death benefit. Whatever premiums she paid in the past are gone. But with term insurance, it is guaranteed renewable. But if the client will choose to renew the plan, it will be very expensive. So let's take this example, 30-year-old female client. What if this client will get a term 20 insurance of $200,000? So her initial premium from age 30 to age 50 for the first 20 years is $18.84. So that's very affordable. A lot of insurance agents will tell you that term insurance is the cheapest insurance in the market. Yes, for the time being. But if the client will renew the term and eventually keep it for a prolonged period of time, it will become the most expensive insurance. Why? Because the renewal premium for this, it will be $163.26 monthly. And from age 71 to age 90, it will become $870 monthly. So average lifespan of Canadian is up to 85 years old. So if this client will continue to keep her plan until age 85, she would have paid around $200,000 also of premiums. So the second insurance now in the market is whole life insurance. So now the market has evolved. They also introduced whole life insurance. It is a lifetime coverage or a permanent insurance. So there are also different payment options. You can pay until you die, lifetime payment, or the most common is pay 10, 15, or 20 years. But if you choose to do an advanced payment method, the premiums will become very expensive. Why? Because your monthly premium will go straight to the insurance company, and in return, the insurance company will give the clients a guaranteed dividends. Dividends is part of the insurance proceeds that you can access in advance while you are still alive. So let's take the same example. 30-year-old female client, what if she would take the $200,000 as a permanent insurance, a whole life insurance? Her monthly premium for the 20-year plan is $208, way more than the term. But that's only 20 years. After 20 years, it's guaranteed that the client is insured for $200,000. So if we do our math for the 20-year period, she would have paid $49,920. But the beauty about whole life insurance, it has a guaranteed cash value. So for example, at age 67, if this client will live up to age 67, her cash value will be $52,524. Again, this is guaranteed. The client will get this. But the question though, is $200,000 life insurance enough for this client? She's gonna have kids, she's gonna marry, she's gonna have a house, she's gonna have a mortgage or car payments. Do you think if she would die and with children depending on her and a husband depending on her, it's $200,000 enough? Of course not. And if she lives up to 67 years old, is $52,000 enough for her to retire? Of course not, right? The third type of insurance, universal life insurance. What is it? It is still a permanent insurance with lifetime coverage, and the client also have different payment options, a lifetime payment or advance payment within 10, 15, and 20 years. But this plan is not as expensive as whole life. Why? Because the monthly premium of the client is split into two. There is a specific price of the insurance, and any excess of the monthly premium will go to the cash value. Cash value is a form of investments that is maintained by the insurance company. But the beauty about cash value, though, because it is owned by the client, every year the client will receive a statement of how much the growth of his or her cash value, and after 15 or 20 years, the client may have the option to stop contributing because the whatever cash value he or she may has might be enough to pay for the cost of insurance. So let's take the for example, if the client really has the budget to pay $208, so let's use the same budget for the whole life. Okay, so instead of getting whole life insurance, this client will get universal life insurance. With this $208 for a 20-year period payment plan, the client may get a permanent insurance of $700,000. So the whole life was $200,000. Universal life, the client may be able to get a $700,000 life insurance plus a term 20 insurance of $300,000 for a total life insurance plan of $1 million plus a critical illness of $30,000. So what it means is for the first 20 years, as long as the client keeps contributing $208, she may be insured for $1 million plus $30,000 critical illness. After 20 years, the term 20 insurance and the term 20 critical illness might disappear. She can renew it if she wants, right? But if she's not gonna renew it, then whatever she paid in the past might be enough to pay for her permanent insurance for $700,000. So the total premium she would have paid for the next 20 years is $49,000, same as the whole life. But the beauty about universal life, it has a cash value. And the cash value, although it's not guaranteed, but it is based on the investment market. So if the market would perform 8% for the next 30 years, this client may get $374,976. Although it's not guaranteed, it is based on an 8% rate of return. So remember, universal life, the $208 is split into two. Okay, so what goes to the insurance? Only $63. So the actual price of the $700,000 permanent insurance, term 20, $300,000, and a critical illness of $30,000 is only $63 on the first year. Okay, so any excess of that is going to the cash value. So that cash value will grow. So it actually makes sense that after 20 years, so from age 30 to age 50, the client will stop contributing, and whatever cash value she may have will generate enough payment to pay for the life insurance, because the life insurance and the critical illness is not actually very expensive. Okay, since the price of the insurance is very low, this is not obligatory. So if money is tight, she can lower her contribution to $80. So the beauty about this plan, it will blend to the client's affordability and current financial situation. So talking about cash value, again, the $374,000 is not guaranteed. I have to stress it out. It is actually based on 8% average rate of return. But based on the market, the US market alone has grown between 12 to 14% in the past 30 years. If what happened in the past 30 years will happen in the next 30 years, I mean, in the next 30 years, if the market will perform actually more around 12 to 14%, this client may get way more than $374,000. Okay, so if we compare all three types of insurance, the term insurance, zero cash value. Yes, the premium will start very low, but it will become more and more expensive as time goes by, and there's no flexible in premium. Same thing with whole life. Whole life is $200,000, although it has a cash value, right, which is $52,000. So the idea here is whatever premium this client paid, actually at least she got it back, right? But still, $200,000 is $200,000. It's not that much, but there's no flexible in premium. This client has to pay $208 monthly for the next 20 years. If money is tight, well, she has to balance her budget and has to pay her insurance. Otherwise, she's no longer insured the moment she skipped one payment. With universal life of $1 million plus critical illness, the cash value could be projected up to $300,000. She could get more if the market will perform more than 8%. If the market will perform, unfortunately, lower than 8%, she might get a little bit lower than $300,000. So The monthly is the same as whole life, but this one has flexible premium. So if money is tight, you can lower your contribution to $80.69. So if you check it, so if you compare all three plans, which one do you think makes a lot of sense? If you're telling me that if it's universal life insurance, I agree with you. Okay, you can maximize your investment or your cash value within the plan based on the portfolio that you selected. So there are so many kinds of universal life. There's so many variations, but there's one specific universal life that I favor the most. It is what we call universal life with retirement options. So what it is a life insurance combined with a retirement cash flow or retirement plan. So insurance, life insurance and retirement combined into one. So I encourage you guys to watch the second part of the video about universal life with retirement options. So please visit our website. It's www.taxcall.ca. On our website, go to tax tips, and in there you will see universal life policy with retirement options. Click that one. It's only a 10-minute video, and watch it, and you're gonna learn a lot of things from it. Thank you for taking time to watch my video. Due to strict guidelines imposed by the investment and insurance industry, I am not allowed to disclose or mention any company or brand within this video. But if you want to learn more about this amazing plan and which company offers this, please don't hesitate to text, call, or email me, and we'll set up a meeting either online or in person, and we'll talk more about this amazing plan. It will be my pleasure to serve you as one of my most valuable clients.